Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Capital flows to where it's treated best, which explains most bad decisions. Artificial intelligence is impressive. Natural intelligence is still in beta. Every tech demo works perfectly until a human touches it. Automation saves time so we can spend more of it fixing automation. We don't manage time, we negotiate with it and usually lose.
This chart quietly breaks your GDP framework. The big four, Amazon, Apple, Google, and Microsoft, just clocked $1.86 trillion in annual revenue. That's not a sector anymore, that's a mid-sized economic bloc with better margins and fewer elections. Amazon alone is larger than most countries' entire output, while the others keep compounding like sovereigns with stock tickers. When markets talk about US growth, this is what they mean. Tech isn't riding the economy anymore, it's dragging it forward. This chart is why boring beats flashy. While everyone argues about tech narratives, the US 2-10 spread, that is the difference between the 2-year and the 10-year yields, has quietly re-steepened to its widest gap since early 2022. Historically, that move, deep inversion, then a clean snap back above zero, has been a recession tell with a 6 to 18 month fuse. Not because growth collapses overnight, but because markets do first. In a highly financialized US economy, falling asset prices are the slowdown. You don't need drama. The curve already did the talking. In my mind, I don't see the US economy falling into a recession, but the US is a highly financialized economy, where even if stocks fall, that economy goes into recession. This is quite an impressive story. In FY26, direct tax collections grew 9%, beating nominal growth of 8%. Not because tax rates jumped. The real driver is better compliance, especially on personal income taxes, which have now outpaced corporate taxes. Translation, the system isn't squeezing harder, it's leaking less. That's the healthiest way to raise revenue, fewer gimmicks, more honesty, broader base. It's dull, incremental, and fiscally powerful. Exactly the kind of trend markets usually ignore until it really matters. This chart shows that India's Capex story hits a speed limit. Government Capex is still rising in absolute terms, but as a share of GDP, it's stuck around 3.1%, no longer accelerating growth, just maintaining momentum. Translation, the public sector has done the heavy lifting, and now it's waiting for the private Capex to show up like a late guest who said, on my way. Without that handoff, growth doesn't stall dramatically, it just quietly underperforms. Roads and railways help, but factories and balance sheets have to follow. This page is a reminder that disruption rarely sends a calendar invite. In 2007, Nokia and BlackBerry saw the iPhone and shrugged. Today, SaaS and IT services risk the same mistake with AI. Pure-play SaaS stocks are already down 50 to 60% from their peaks, while Indian IT still trades at premium valuations, even as generative AI starts automating the very services they build by the hour. Markets aren't punishing earnings yet. They're discounting relevance. When the business model is questioned, multiples move first and explanations follow later. As Andy Grove once warned, only the paranoid survive. This is not just a renewable story, it's an infrastructure one. India's biggest solar parks now rival thermal plants in scale, clustered where land, sun and transmission finally align. Rajasthan and the Deccan are doing the heavy lifting, quietly lowering marginal power costs and reducing import risk. The real constraint now isn't ambition, it's grids, storage and execution. Capacity is no longer the headline, integration is.